Have you ever wondered if that spare bit of cash, perhaps just £250, could actually turn into millions? It might sound far-fetched, but it's not as impossible as it seems. And just so you know, this video is part of a growing series where I break down how small, consistent investments can lead to real financial transformation. I'll be sharing more content like this, including strategies for building wealth through investing, passive income, and long-term financial planning. So if you're serious about taking control of your financial future, you're in the right place. It sounds like a lottery dream, doesn't it? But unlike the lottery, this isn't about luck. But what if I told you that with the right approach and a bit of patience, growing a small sum into something substantial is more achievable than you might think? It's all about strategy and time. This isn't about wild gambles or risky schemes. It's about making informed decisions. It's about understanding the power of the stock market and making it work for you. Knowledge is key. The secret ingredient is something called compound growth or compounding. This is where the magic happens. Albert Einstein supposedly called it the eighth wonder of the world, and for good reason. Put simply, it's your money making money, and then that new money making even more money. It's a cycle of growth. Imagine a snowball rolling down a hill. It starts small, but as it rolls, it picks up more snow, getting bigger and bigger. The same principle applies to your investments. Investing works in a similar way. The initial amount grows over time, gaining momentum. When your investments generate returns, those returns can then be reinvested, generating their own returns. It's a powerful cycle. Even small, consistent amounts like that £250 we mentioned can make a real difference when invested wisely over the long term. Let's get going and unlock your financial potential. Let's be clear, the stock market is not a one-way ticket to guaranteed riches. Think of it more like a roller coaster. There will be thrilling climbs, stomach-lurching drops, and periods where it feels like you're just trundling along. These fluctuations are a normal part of investing. News headlines will scream about market crashes and economic doom, and it can be tempting to panic when you see the value of your investments fall. But seasoned investors understand that volatility is the price you pay for the potential of higher long-term returns. History provides some fantastic lessons in market resilience. Consider Black Monday in 1987. The dot-com bubble in the early 2000s, the 2008 financial crisis, and the COVID-19 pandemic. After every single one of these major crashes, the stock market has eventually recovered and reached new higher peaks. The key is a long-term perspective. If you were invested through those periods and didn't panic sell, your portfolio would likely have bounced back and continued to grow. Before you rush off to open an investment account, there's a fundamentally important step you must take. I'm talking about getting your existing finances in good shape by building an emergency fund. This isn't the exciting part, but it's crucial for your financial well-being and your success as an investor. An emergency fund is a sum of money you set aside in an easy-to-access savings account for unexpected financial shocks. The general rule of thumb is to have enough to cover 3 to 6 months' worth of essential living expenses. Keep this money somewhere safe and liquid, like a top easy-access savings account. Your emergency fund gives you peace of mind and allows your investments the time they need to grow. Assuming your emergency fund is healthy, we can now move on to the more exciting bit, getting yourself set up to invest. Opening an investment account in the 21st century is remarkably straightforward, often taking just a few minutes from the comfort of your own sofa. There's a wide array of investment platforms available to UK residents, all vying for your business. Popular choices include platforms like Trading 212, Hargreaves Lansdown, AJ Bell, and Vanguard Investor. To open an account, you'll typically need to provide some personal details and verify your identity. Once your account is approved, the next step is to fund it. Most platforms allow you to deposit money using a debit card, a direct bank transfer, and some even support methods like Apple Pay or Google Pay. You can start with a lump sum or set up regular payments to invest a smaller amount each month. This accessibility is a game changer, empowering you to take control of your financial future. Now that you know how to open an investment account, let's talk about a brilliant way to make your money work even harder for you. It's all about being smart with your taxes. In the United Kingdom, the star player in the tax-efficient investing world is the Stocks and Shares Individual Savings Account, or ISA. Each tax year you have an ISA allowance. Any money you invest within this ISA wrapper can grow completely free of UK income tax on dividends and capital gains tax on any profits you make. Other countries have similar schemes designed to encourage saving and investing. Using these accounts should be a top priority for most long-term investors. Every pound or dollar you save in tax is a pound or dollar that can remain invested and continue to compound. Over decades, the difference between investing in a taxable account versus a tax-advantaged one can amount to tens or even hundreds of thousands of pounds. So, when you're setting up your investment account, make sure to explore the ISA or equivalent options offered by your chosen platform. So, your investment account is open, perhaps neatly tucked inside a tax-efficient ISA, and you're ready to choose your first investments. My strong advice, especially when you're starting out, is to keep it simple. Forget trying to find the next big thing or picking individual company shares. Instead, become familiar with a wonderful invention called the index fund or tracker fund. An index fund doesn't try to be clever and pick winners. Its job is simply to replicate the performance of a specific stock market index. The beauty of an index fund lies in its inherent diversification. Because your money is spread across hundreds or even thousands of companies, you're not overly reliant on the fortunes of any single one. Furthermore, these funds are usually very low cost, as they don't require expensive fund managers to make active stock-picking decisions. Simple, diversified, low cost. That's the index fund mantra. And one of the most powerful strategies for building wealth through investing isn't about complex algorithms or insider knowledge. It's about something far simpler: consistency. Making regular planned investments over a long period, regardless of whether the market is up or down, is a cornerstone of success for many ordinary investors. This approach is often called dollar cost averaging, or in the UK, pound cost averaging. The easiest way to ensure consistency is to automate your investments. Most investment platforms allow you to set up a regular direct debit from your bank account, which then automatically invests a chosen amount into your selected funds or shares each month. This set it and forget it approach has several benefits. Firstly, it instills discipline, ensuring you invest regularly without having to actively remember or make a decision each time. Secondly, it helps you avoid the temptation to try and time the market. By automating your investments, you're making a commitment to your future self, steadily building your wealth one small, regular step at a time. What are you waiting for? Now, for the really exciting part, dreaming a little about what your consistent efforts could actually achieve over the long run. Imagine the possibilities that come with disciplined investing and the potential growth of your savings. While nobody has a crystal ball and all investments carry risk, looking at historical market averages can give us an inspiring glimpse into the potential future value of your savings. Historical data, though not a guarantee, can provide a sense of what might be achievable. Many investment platforms offer projection tools that can estimate how your money might grow based on certain assumptions about annual returns. These tools can be incredibly motivating, showing you the potential of your investments. Let's take that £250 per month figure we've been discussing. This amount, though it may seem modest, can be the foundation of significant future wealth. If you were to invest that amount consistently, and if your investments achieved an average annual return in line with long-term stock market performance, the numbers can become truly eye-watering over time. The power of regular investing cannot be overstated. For example, some projections suggest that £250 invested monthly for 30 years could potentially grow to anywhere between £700,000 and well over £1 million. This is the magic of compounding at work. These are life-changing sums built from modest regular savings. Imagine the financial freedom and opportunities such growth could provide for you and your loved ones. The longer your money is invested, the more time it has to benefit from the power of compounding and to ride out any inevitable market downturns. Patience and consistency are key. This makes the case for investing even stronger for long-term financial goals. By starting early and staying committed, you can harness the full potential of your investments. We've covered a lot of ground, from understanding the potential of small sums to navigating the practicalities of setting up accounts and choosing initial investments. These steps are crucial in laying the groundwork for your financial journey. The journey from £250 to a potential fortune isn't a mystical quest. It's a path paved with sensible decisions, consistency and, above all, patience. Each step you take, no matter how small, brings you closer to your financial goals. It's not a get-rich-quick scheme, and anyone promising you that in the stock market is best avoided. True wealth building through investing is a marathon, not a sprint. It requires endurance, careful planning, and a long-term perspective. The core message for any beginner investor can be distilled into a few key principles. Firstly, just start. Even if it's with a small amount, the act of starting is the most important hurdle to overcome. Procrastination is the enemy of progress. Secondly, aim for a diversified portfolio. For most people, low-cost index funds are an excellent way to achieve this without needing expert knowledge. Thirdly, invest regularly and, if possible, automate the process to build discipline and take emotion out of the equation. Automation helps you stay committed even when the market fluctuates. These simple actions form a robust foundation for your long-term investment strategy, helping you to build wealth steadily over time. Remember, the power of compounding works best with time. Your journey to transforming your financial future doesn't start one day, it starts the moment you decide to take action. The sooner you start, the better. That moment can be right now. Don't wait for the perfect time. Make the time perfect by starting today. And there you have it. Your roadmap from just £250 to potentially life-changing wealth. It's not about luck or timing the market, it's about consistency, patience, and smart decisions. If you found this video helpful, please hit that like button. It really helps the channel grow and reach more people who want to build wealth the right way. Drop a comment below and let me know what's your biggest takeaway from this video, or what's stopping you from getting started. And don't forget to subscribe. This is just one part of a growing series where I share practical strategies for investing, building passive income, and taking control of your financial future. There's so much more to come. Thanks for watching, and remember, your financial future starts with the steps you take today.